Of all professions, the crown for most misleading name goes to investment banking. Because investment bankers, one, don't do any investing, and two, don't do any banking. So what in the world do investment bankers actually do? In today's video, I'll explain investment banking once and for all, the function, the business model, and the day-to-day job itself. Hello friends, if you're new to this channel, my name is Kevin Yang, and I spent years in investment banking before transitioning into private equity, venture capital, and ultimately impact investing. This channel exists to help you land your dream job in business and finance, especially in careers that make a positive difference for people and planet. So let's dive in. In investment banking, you are effectively serving as a financial advisor to companies in different corporate finance transactions. Which raises the great question, what the heck are these different corporate finance transactions? There's two main categories here, and then we'll give one honorable mention. The first category is mergers and acquisitions. The second is capital financings. And lastly, our honorable mention is restructuring. Okay, let's define each of these. Mergers and acquisitions, pretty straightforward. This is buying and selling companies, more commonly referred to as M&A. Capital financings, this is basically a fancy way of saying raising money. You help companies raise money. And you do this through either the debt capital markets or the equity capital markets, DCM, ECM. Lastly, restructuring, you're not going to see this at every investment bank, but this is managing liabilities in bankruptcy or distress scenarios. And that's all investment banking is. You're serving as a financial advisor to different companies, helping them buy companies, helping a company sell itself, or you're helping a company raise money. That's investment banking. Now that we've covered the basics, let's get into a little more detail about what exactly an investment bank's role is when it comes to M&A. In any M&A process, you're going to have a buyer and you're going to have a seller. Let's take company A and company B. And then we know that our investment banks are going to get involved as well. One for each buyer party and one for each seller party. So the first way an investment banker gets involved with the process is through ideation. An investment bank might go to a company and say, hey, I don't know if you've thought about this company B that's out there, but they might be a really interesting addition to help grow your company. Now, the strategic rationale for M&A typically falls into at least one of three buckets. The first being geographic expansion and moving into new markets. Second is product expansion or capability that you don't have in-house already. And third is just consolidating the market, in which case, do not say the M word, monopoly. Now, company A and company B, maybe their CEOs are already lightly familiar with each other, and they've talked before. And so they float the idea like, hey, company B, would you be interested in possibly joining arms and, we could pay a good price for you? And company B says, I'm interested, but I have to kind of get my affairs in order. I have to figure a couple things out. And so company B then goes to approach the investment bank and says, what is my valuation? And that is the really important part of investment banking. How much is this company worth, and are they going to get a fair price for it? Now, the investment bank and company B, they talk and they ultimately decide, yes, we want to run a process. In which case, the investment bank is going to help prepare marketing materials to best position company B and get the best price possible. Now that company B is formally in a process, company A knows that things are heating up and getting serious. It's going to retain and hire its own investment bank as well. And these investment banks are going to work together and coordinate with each other on managing the process. Because if company B is going to work on selling itself and company A is interested, chances are there are going to be other buyers and other companies that are going to be interested as well. And this investment bank wants to get the best price possible, and so it's going to approach each and every single one of them as well. And now that these companies and banks are in conversation, the banks work to facilitate diligence, and they also work on the transaction documentation and also negotiations. Maybe on the buyer side, it could be the investment bank advising company A on what is their best bidding strategy to clear the first round and move into the second round of bidding. Now, the best comparison and analogy for what an investment bank does is really similar to a real estate agent. If you replace the investment banks here with real estate agents and you replace the companies with individuals that are looking to buy a home or looking to sell a home, all of this same work still applies. Your real estate agent might go to the buyer and say, hey, I found these new properties that popped up in these neighborhoods that fit your profile and have all the things on your wish list. The real estate agent could tell you whether they're being listed at a good price or not. The real estate agent for the seller manages the process across all of the different buyers to get the best outcome possible for its seller and its client. And at the end of the day, they'll help facilitate the diligence, such as the disclosures, and they'll help on the bidding strategy and those final negotiations to get the deal over the finish line. So that's what an investment bank does in M&A, just with companies. Now note, there's nothing that stops these companies from doing all of this work themselves. You don't have to hire an investment bank to go through this process, but it is a lot of work and the valuation is really specialized. And so oftentimes it's easier to outsource and bring on some additional help. So that's M&A. Now let's move on to capital financings. Remember, capital financings is just a fancy way to say raising money. And there's two ways that you can raise money. The first is debt. I'm going to borrow some money today and I'll pay you all of that money back at some future date. And in between, I'm going to pay you interest payments as a cost for letting me borrow this money up front. You can also raise money through equity. You can sell ownership in your business. Whenever you hear the word equity in finance, I want you to think ownership. Equity equals ownership. Specifically for an investment bank when they're involved, this is typically through an IPO or an initial public offering. Now, a couple different parties that are involved here. First, the company itself. Next, you have the investment bank. And then lastly, you have this category called institutional investors. This is my attempt at a skyline. In the financing flow, it's going to happen left to right here. I'm going to talk through an example using an IPO, but the same principles and ideas apply to debt as well. So a company needs money. Maybe it's to finance an acquisition, or maybe it's just to invest in an area of the business that it wants to grow. A company is going to hire an investment bank to help manage its IPO process. And the investment bank does a lot of similar work that it does when it comes to M&A. It's going to manage the pricing or conduct the valuation. It's going to prepare the marketing materials to get buyers interested. And it'll also manage the transaction docs. Lots of regulations when it comes to public securities. But the most important job of the investment bank when it comes to IPO is going to be building demand. And the investment bank in this instance serves as the book runner. So for an IPO to go well, it's the job of the investment bank working alongside the company to get institutional investors to want to invest in the company and invest in the IPO. Now, who are these institutional investors? They are hedge funds, mutual funds, pension plans, endowments, and sometimes you have ultra high net worth individuals as well. Now, the last big role that investment banks play when it comes to an IPO is that they're going to serve as the underwriter. Underwriting can mean a lot of different things in a lot of different contexts in finance, but in the case of an IPO, it basically means that the investment bank is going to serve as the backstop for this IPO to make sure it goes successfully. And here's how the financing funds flow actually works. When a company sells its ownership, it's actually going to sell its ownership to the investment bank first at just a little bit of a slight discount. And because the investment bank has already built up the demand from these institutional investors, that same day that the investment bank acquires the equity or the ownership from the company, it's going to flip it and turn it around and over to these institutional investors. In doing so, they're underwriting that transaction. So we know the transaction that the banks advise on, but how do they actually make money? What is the investment bank's business model? Now, for both M&A and for capital markets, it is going to be a percentage of the transaction value. But for financings, this comes with a little bit of an asterisk. And that's because of something called the OID. This is the original issuance discount. And we just saw on our financings that the way that the financing works, the company sells the security, either the debt or the equity, to the investment bank at a slight discount, and the investment bank flips it over to the institutional investors at the full price. And whatever that discount is, that's going to be called your underwriting spread. So let's take an example where a company makes a $1 billion acquisition. Now, if this bank advised on that acquisition, it'll take a percentage of the transaction value. So let's say it was a 2% fee for the M&A. Now that's going to be a fee and payday of $20 million. And then we could look at how they financed or raised money for this transaction. We're going to say it was financed by $760 million of cash on hand. That's cash that was already on the balance sheet. And $250 million of a debt raise that this investment bank advised on. Now, the astute among you are going to notice that this doesn't total to $1 billion. It totals to more than $1 billion. And the reason for that is because of the OID. Let's assume that this was a 4% OID. So off of $250 million, 1% is 2.5 million and 4% is 10 million. That is the bank's payday. And that means that the company is only going on this $250 million raise, only brought in $240 million of cash proceeds. Because again, if we look at this model, the company wanted $250 million in debt. It sold that debt to the investment bank at a slight discount, $240 million, and the investment bank flipped it over to the institutional investors at that full price, $250 million, and took that underwriting spread for themselves. And that is the investment banking business model. The fun continues because there are different types of investment banks. When you think of an investment bank, you're most likely thinking of the bulge bracket investment banks. These are names like JP Morgan, Morgan Stanley, Bank of America, Citigroup, Goldman Sachs. Why are they called bulge bracket investment banks? That is because their organizational structure looks a little bit like this, where they have lots of different divisions, products, and services. One of those divisions being investment banking, that's your M&A, restructuring, capital financings. But there's also sales and trading, where you're making markets. There's asset management, where you're managing other people's portfolios. There's consumer banking, that's the Chase and JP Morgan Chase. And there's also commercial banking, where you're serving as the bank account for a business itself. And there may be other categories beyond this as well. The next type of investment bank is your middle market investment bank. Now, the middle market investment banks are effectively the same, but for smaller companies, or they might be regional services only. This includes names like Truist, William Blair, Houlihan Lokey. Our last category of investment banks to know are the boutique investment banks. Now, the boutique investment banks are unique in that they do investment banking only. That's this category here. And some of these boutique investment banks go even further and do M&A only. I worked at a boutique investment bank. This includes names like Centerview, Evercore, Lazard, Guggenheim. We understand how these investment banks operate, but what does it actually look like for an investment banking analyst on a job day to day? An IB analyst works a lot. You're typically going to clock an average work week of about 80 hours, is what they say to expect. But you get compensated really well for it. In your first year, you probably make more than $150,000 all in. Some of my friends made $300K in their first year in banking. But what are you doing for 80 hours a week? Now, if this represents your time, there's 4 main segments that I'd like to think of your work in banking. The first is you're going to be spending a lot of time in Excel, and you're just going to be spending a lot of time in PowerPoint. The next category, I'm going to call it miscellaneous work. And the last category, I'm going to call it waiting around. So what are you actually doing in Excel? You are doing the modeling, the financial valuation analysis. You're responsible for getting all of the numbers correct. Then in PowerPoint, you're taking that information, you're making pitch decks, and you're also creating those marketing materials. That could look like management presentations or maybe teasers. This miscellaneous work, you're going to be on calls, you're going to be taking notes, you're going to be doing research, you're going to be doing scheduling, and maybe you're helping out with recruiting activities at the firm too. And then lastly, when you're waiting around, try to stay sane. And the job changes and evolves as you go from the most junior analyst role into the middle management VP and senior level managing director roles. As you get more senior, a managing director is going to be a lot more client facing and almost is a salesperson. You're effectively a client relationship manager working with these businesses, working with C-suite executives, and your main job is to bring in business to the bank. And if you don't bring in business, you get the boot. But it can also be extremely lucrative. And a lot of your pay when you're in the senior level is going to come from commission. And I had one senior managing director, after they closed, say like a $40 billion M&A buy-side transaction, he took home a $15 million commission and payday for himself. If you're considering a career in investment banking, or really any career in finance, then you should check out my guide on the industry's #1 most common technical question, because it is just about guaranteed to come up in your interviews, and when it does, you want to be prepared. Lastly, if you learned something today, please consider subscribing, and I look forward to seeing you in the next one.